from where you sit. Welcome to the Trading Bell. My name is Abi Agina. We're coming to you from the trading floor at the NSE. Today we'll be hosting Dan Awendo, the Chief Executive Officer of Home Africa, a real estate company. But really, who is Dan Awendo? Well, Dan is a certified public accountant, management consultant, financial analyst, and an advanced management program graduate of Strathmore Business School and IEC Business School in Spain. Awendo has worked in senior management positions in both local and international companies and has been a board member of various companies and learning institutions in Kenya. Thank you, Dan, for coming.
You're most welcome.
Welcome to the Trading Bell.
Thank you.
Please have a seat. Well, it has been a turbulent 2017, and we did see a prolonged electioneering period. And many of the people in the real estate sector have come out saying that this did have a big impact on the real estate. Perhaps for Home Africa, what was the situation like?
Well, it is true that there was a big negative impact. A lot of companies experience a lot of negative growth in terms of their turnovers. But we at Home Africa actually experienced a growth, a positive growth. Interesting to note that we achieved more than 20% increase in our turnover, which was quite commendable given the situation the market had provided.
Yeah.
The environment was a little more difficult. There were more people who were changing their minds in buying property. But we found that as you diversify product, as you offer clients better payment terms, better incentives, they're able to make the decision to buy the property. So
sure.
Last year we did much better than we did before.
Well, looking at 2018, we're heading almost to the third month of the year. How do you see the real estate sector has been performing this year?
Well, the thing that we have noticed so far is that a bit more confidence has come into the market. We see that those who had made decisions not to buy property towards last year, especially towards the election time, are starting to come back to the market to look at the property and to even make the decision to buy. So we see, at least at Home Africa, the performance for January and February has been very, very commendable. Looking at all the things that have been going on, and we hope that that confidence level will continue in the market, and that will continue to sell more as the year grows older.
And Dan, testament to that, I've been keeping a track of your stock at the NSE, and it has been really on the gaining end. Perhaps looking at the broader picture right now, many people fear listing at the NSE. Perhaps what has been your experience like when it comes to growth in the business and of course looking at other opportunities to raise capital?
Well, I think that if you think of the NSE as a capital market platform to help you raise capital, you certainly are in the right place. We at Home Africa decided to come onto the stock market primarily because we're looking to raise capital, but we're also looking to expose our share to the public, which then gives us a price discovery, so that shareholders also then have a quick market to be able to sell their shares and to ensure that they can buy them back if they wanted to. But also, thirdly, we know that for as long as you're on the stock exchange, you get good coverage on a monthly basis, on a daily basis, and as your share is being traded on, you know that the level of confidence that the market has, at least as far as the things that you're doing in the company are concerned. But I think finally and critically, governance and accountability is something that the NSE takes seriously, and I guess also the capital markets generally. And we find that we obviously are under pressure to ensure that our governance is up to par and we are accountable to the stakeholders that we work with.
All right. And I raise a very important point, Dan. Looking at a majority of the SMEs, some of the reasons that they are shying away from coming to the stock exchange is this sheer fact that they are going to lose control. What would be your message to them when it comes to how to balance all these interests?
I think it's just a fear. There is really no truth to it. You know that if you do list on the stock exchange, you don't have to list more than 51% of your control of your share, which then obviously gives up, or you are able to give up your control. But I think that what people should be looking more at is the advantages on capital raising, advantages on price discovery and things like that, because control is something that you give up when you decide that you're giving up. Coming on the exchange does not by itself get you to lose control.
Sure. Yeah. And let's take this conversation forward, Dan. Looking at the valuation of your stock, it's at about $1.50, and it keeps oscillating around that. Perhaps this is one of the reasons that many people also consider coming to the markets, is the fact that your share can eventually appreciate, and if I'm an investor, I'll be able to make a decent return at the end of the day.
I think that what people don't see is the fact that our share is quite cheap. If you savvy with numbers, you will realize that the share at 1.5 shillings gives us a market capitalization of about 600 million shillings. But if you look at the balance sheet and look at the value of the asset that we are sitting on, remember we are a real estate development company, so the significant part of our balance sheet is made up of land, whose valuation continues to grow on a day-to-day basis.
Oh, yes.
So if you look at the valuation of the land that we are currently sitting on, the land bank that we have is way, 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 way above the market cap that we have.
All right.
And so long as we have the governance structure that, that supports catalyzing that land bank into proper property that people can buy, I think that whoever shareholder comes on board, buys a share at that price, will make money.
And linked to this, Dan, right now we are seeing a lot of government interest when it comes to addressing the pertinent questions around housing. It's actually featuring in President Uhuru Kenyatta's Big Four agenda to provide housing to the residents of the country. Perhaps what opportunities lie for Home Africa, knowing pretty well that the annual housing demand is pegged at about 200,000 units, and this is on an average estimate,
First of all, I think it's commendable that government can take housing as a major deliverable, particularly in this political dispensation, the next 5 years. I think it's fantastic. But I think government needs to be careful not to get involved in the business. Government is not always good in doing business, not just in Kenya, but anywhere in the world. And so government needs to be a catalyzer. They need to provide the environment and provide the incentives for private sector to play their role, which means that they need to use their position as government to leverage. So government has, say, 10 billion shillings to put in projects. That alone can catalyze an additional $100 million just to be able to expand the opportunity for the housing sector. The mistake that government does is to assume that the 500,000 houses that they want to do, they have to do them themselves. They need to, I think, understand the entire value chain of housing development, so that whatever resources they have, they put it somewhere in a central place and get other players, private sector, international players, to come and use that central resource to be able to expand the leverage capacity. That way, government will be able to do many more than 500,000 houses.
Sure.
Because they are not having to do them themselves, but they are providing the environment, providing the incentives for the private sector to do their job. And
speaking to this, of course, we've seen other models being rolled out in countries like South Africa, Egypt, Rwanda. And let's come back home, Dan. Looking at this ambitious plan by the government, as a developing company, right now a number of projects are already in the pipeline. Just share with us which properties are soon coming to the market, and what's the sentiment like?
So first of all, the biggest need in the market is in the affordable housing space, and that's a fact I think everybody accepts.
When you say affordable, how much are you talking about?
I'm talking houses that are less than 5 million shillings.
Okay.
If it's expensive, then it can't be more than 7 million shillings. But I think the sweet spot will be anywhere in the region of 2, 3 4 million shillings. Now, delivering that kind of a house is not a normal development space. You know, there has to be a lot of other variables that you have to be considered. Pricing of those houses, the technology that is used for those houses, the interest rates that are applied into the development space, into the off-taker, people who are buying, how are they accessing mortgages, what prices are they accessing them at, and so on and so forth. So I think that the opportunity at affordable housing space is really where the market is going to. And so players like Home Africa really want to partner with government to deliver units at that level, because really that's where the demand is, and that's where I guess even at a volume basis the profit also sits.
All right. And to address these needs in the market, just walk us through some of the projects that Home Africa is currently working on, and what's in the horizon really for 2018?
Okay. Let me take you back maybe 2 years ago. We started a process of re-engineering, restructuring the company. That's what I'm doing there, to lead a change management process. And when we started this process, we determined that, look, you're better off finishing the projects that you have, as opposed to going and taking new projects, and yet the ones that you have, you've not completed. So we spent a lot of time rebooting, basically, the projects that we have, or re-engineering the structure of the projects that we had. So Miga, for example, Miga Golf Estate is our largest project. It's 774 acres. It will take us a bit of time to finish that.
Sure.
Our responsibility is not really in the development of the houses in there, but more of the infrastructure within the facility. And that's what we are putting our efforts in. We expect that within the next 2 years, 3 years max, we should have completed the requirements of all the infrastructure requirements, and then we exit to do now other developments. The next phase for us is the affordable housing. We have already started scoping projects. We have a project in Togoto that we are trying to put together.
Yeah.
Our expectation is that the projects that we do will not sell for anything more than 6 or 7 million shillings. We believe that that's where the space is, and that's the opportunity we want to take. Now remember, Home Africa is a listed company, so we feel that we have the credibility and the governance and the structure that should be able to attract capital, and that should be able to attract other partners that can help us deliver this kind of units. Yes.
And as we come to the tail end of this discussion, Dan, what's the outlook really for the real estate sector from an uptake point of view? Because we are seeing developers delivering excellent products to the market, and on the flip side, the buyers, where are the buyers? Looking at different dynamics, we've seen interest rate caps. This has stifled credit uptake in the economy. Is there hope that we won't end up in a glut of sorts?
So first of all, if you think about the interest rate capping and what result it brought, the first thing is that developers were able to access cheaper loans to do the development. So the reason you're seeing developments coming across is because there is cheap capital or cheaper interest rates than they were experienced in getting. Now the flip side is that while the developers are getting cheaper interest rates, the buyers on the other hand are being closed out from access to capital, because banks are facing two problems. Problem number one is that 14% may not be as profitable for them compared to the previous regimes.
Yes.
If they were to invest it in loans to buyers of homes. So sometimes they would prefer to invest it on treasury bills, other treasury products. But secondly, the opportunity space for them is looked at from a risk perspective. So they have to take risk to provide loans. Will they be profitable in providing loans at 14%, given the level of risk they're taking? That's a question that is difficult for a lot of people to understand.
Sure.
So because of that, the banks have taken a back step and stifled credit, which means that yes, you have buyers, you have developers delivering product, but you don't have buyers who can access the same capital to be able to buy houses, and that's where the problem sits. Interesting mismatch.
And we can't exhaust this in one sitting. Many thanks, Dan Awendo. And indeed, interesting insights there on the real estate. We now want to transition into the financial analysis. What's happening in the banking stocks? From where you say?
We've seen interest mostly from foreign investors.